Hi, this is Dan Collins, live from the Las Vegas Traders Expo, and joining me is Dan Freifeld, lead mentor for Macmillan Analysis Corp. Hey, Stan.
Hi there, Dan.
And Stan teaches people about options, and one of the greatest things about options is it's a really precise tool. So Stan's going to talk to us a little bit about what you can do with options and why it's such a great tool for traders.
Well, I'm going to talk to you about the difference between directional trading and volatility trading. And I want you to know I'm a volatility trader. And I'm going to tell you why I'm a volatility trader. A lot of people think of options as predicting where a stock is going and then buying calls or selling puts if they think the market is going up, or buying puts and selling calls if they think the market is going down. That's called directional trading. That's not exactly what I do. I tend to think more in terms of volatility. Do you want me to explain why?
Go ahead.
Okay, great. Options are based on three variables, mainly direction, or the price of the stock, time to expiration, and volatility. There's also interest rates and dividends. They play a small part. Anyway, if you think about it, time is very predictable. If there's 30 days today to expiration, tomorrow there's 29, the next day there's 28. We could all predict time. Okay, so the theory of a volatility options trader is that if we take price out of the equation, then we're just left with volatility. And our belief, when I say the volatility traders, is that volatility is mean reverting. So if volatility right now happens to be low, then it's probably going to go back up. And if volatility is high, it's probably going to come back in. In other words, go down. So we tend to try and buy volatility when it's low and sell it when it's high. In fact, an interesting thing, Dan, when you talk to your friends perhaps about trading, you might say, I bought something for $1, I sold it for $1.50, or maybe on a good day $2 or $3, right? When I talk to my buddies from the floor, not so much to retail traders, but it used to be I bought this option at a 30 vol and I'm selling it at a 34 or a 35 vol. That's how important volatility trading really is.
Well, and there's more tools for volatility traders. You listen to CNBC, you listen to a business network, they're going to give you the price of the VIX along with the Dow Jones and the S&P. That's new. That's something in the last couple of years. So are retail traders more aware of volatility and how it affects the performance of not only options but the market in general?
I would say the successful ones are.
Okay.
They should be. I mean, it's information that you have that years ago was just not available to retail traders. And now every news station has that kind of information.
Is that good, or can that be a little bit dangerous? Because the VIX is quite complex.
The VIX is very complex. And in fact, for trading equities, the VIX probably isn't the most important thing to look at. I want to look at the volatility of the particular set of options that I'm trading. So if I'm trading IBM, I want to know what is the implied volatility of options on IBM. But the VIX gives you a general indication of where volatility is in the market. Is it very high relative to where it's been, or is it relatively low?
Okay, well, we're going to take a little break, and then we'll return with Stan Freifeld to talk more options, more volatility, live from the Las Vegas Traders Show.